Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today we are rebroadcasting a mashup of two separate episodes recently that dropped on the Benson Wealth podcast, which is hosted by financial advisor Drew Benson. So specifically, Drew had me on his show talking about, we covered a bunch of stuff, but the main categories they divided up into were the economics of AI and cryptocurrency and stablecoins in particular in the Genius Act. All right, so that was the two ways that they sort of split up our conversation when they released it as two separate episodes. We combined it into one flowing conversation here for you folks at InFi, and it's stuff that I think is very relevant to the things I talk about here on the podcast and what we're doing at Infineo, in as much as we are an AI company or tech company that uses AI to put life insurance on the blockchain. So I think that's really all the prep we need. And so without further ado, here is my conversation with Drew Benson.
Hey, Bob. Thanks for coming on the podcast again. It's great to see you.
Nice to see you, Drew. Glad to be here.
So we're going to talk a little bit about stablecoins today, about crypto. We're going to talk about AI. So I've been eager to dig into these topics with you because I know that you're spending a lot of your time and research in these specific areas, and you actually work in an industry now that deals directly with crypto and with AI. So I'm excited. So Bob, you've long been a defender of sound money and market-based solutions. Can you give the audience like a quick primer on like what does sound money really mean in today's digital economy?
Okay, sure. So maybe the way to answer that specific question is to first answer what did sound money mean historically.
Yeah, agreed.
And so and I'm drawing here, I'm a member of the so-called Austrian School of Economics, and my hero and intellectual, the person who gave me the worldview that I use the most is Ludwig von Mises. And so in his work, he championed what he called sound money. And the idea was the citizens needed protection from the prince or the political class from debasing the currency. That was the idea. And so and Mises said in his writings, I'm not going to get the exact wording right, but he said something like, in the classical liberal tradition, the principle of sound money is analogous to like the protection of free speech, like in the Bill of Rights or something. And he's saying, so it wasn't just an economic thing. It was more that you're providing a zone of protection, just like the government can't throw you in jail for criticizing the government. And everybody knows in a free society, that's got to be true. By the same token, in a free society, it can't be that the political officials can just take away 30% of the purchasing power of your money just by running the printing press, right? So that was the way he was saying that it was part of like limiting the power of the government to do bad things to you. And so that's what sound money meant. And that's why it was such a part of the classical liberal tradition, not just among economists, all right? But so back in those days, of course, it meant commodity money like gold or silver, and that was sound money, as opposed to government fiat currency, which isn't backed up by anything, because the primary virtue of commodity-based money, either people literally just walking around using gold and silver coins, or what eventually became to be the case that, yes, there was the US dollar and the French franc and the British pound and so on that were paper, but they were ultimately redeemable for a fixed amount, a fixed weight of gold and or silver, depending on the time frame you're looking at. And that kind of kept them honest, right? They couldn't print, the U.S. authorities couldn't issue too many dollars because anybody could just turn them in and get the gold for it. And so that kind of kept it within limits. If they printed too much relative to other nations, gold would flow out of the vaults of the U.S. authorities and into the vaults of the Bank of England or the Bank of France or whatever. All right. So that's kind of the backdrop there.
Some discipline.
And of course, that all was completely, the last vestiges of those constraints were completely eliminated in 1971 when Nixon put the final nail in the coffin. The classical gold standard had been getting hammered ever since World War I forward. Like it never got back to the 1913 meaning of what people thought of as the classical gold standard. But yeah, Nixon in 71 completely killed that, where now the dollar wasn't tied to anything. That the U.S. authorities were saying, no, if you come in and give us a $100 bill, we'll give you 520s, but we don't owe you anything. It's not a claim on anything. It just is what it is. And it's not a coincidence that when was the worst peacetime inflation in U.S. history? Oh, it was in the 70s, right after they did that. Right.
Interesting.
So that's, anyway, so that all fits. And, the intuition's pretty straightforward. If the authorities can just print money, with the only constraint being if prices rise too rapidly, the public's going to get upset. They're probably going to print a lot of money, right? Okay, so with that context, then now in the age of blockchain-based digital currencies, let's say, then
Sure.
blockchain-based is a particular variant of that, was part of the drive for Bitcoin originally. Like if you go and read, there was this whole subculture of people who could see the problems, the downsides of government-issued fiat money. Fiat just meaning like it's not backed by anything. It is what it is
just
because
paper
the
dollars
says so. Yeah.
Right.
And then there were various proposals like Friedrich Hayek, another giant in Austrian economics. He came out with a pamphlet where he had argued for, he said it's not fiat money per se that's the problem. It's government monopoly of it. And so if you had different private companies issuing like paper money,
distinction.
Electronic claims or whatever that weren't backed up by anything. It wasn't like, oh, this is just a ticket entitling you to an ounce of gold or something, but just that they used, if they could get it launched and the public started using those as monies, as long as it's all voluntary and private, he was arguing there was competition between these entities issuing them. And he just spelled out the economics of that and what that might look like. And so his point, and different, like Murray Rothbard didn't like that, right? So I'm not saying this what the Austrian position is.
That's
but I'm just saying that this is like partly, I'm just so your audience isn't getting lost, Drew. I'm just trying to explain like the intellectual development leading up to this stuff. So Hayek wrote all that, I think that was in the 70s, in the context of just paper-based, and then, understanding that banks had electronic, they could, we had computers and stuff in terms of ledgers, entries, but there was nothing like blockchain at that point in our modern terminology. And so anyway, the issue, people were trying to, they're called like cyberfunks, and what they were trying to come up with as technology was advancing, and and especially then once the World Wide Web comes along and everything, they realize there's got to be some way here. But the problem that they couldn't quite solve is there still is this issue of trust. Like even in Hayek's system, and this is what some of the critics pointed out, once an institution that was issuing like private fiat money got people using it, why couldn't they just print a quadrillion of them? You know what I mean? Like, and then go buy all the stock markets in one night before anybody realizes what happened, and then say, and then you could say, oh, well, people will stop using their currency, but they already bought everything. You know what I mean? So there were issues like that where there was this fundamentally, whether it was governments or private companies, people were trusting them to be responsible, and certainly with competition and whatever, the harm would be limited if you had it private and voluntary. But still, there were those issues. And so that's what the genius behind Bitcoin is it was this way to get this decentralized ledger that nobody was in charge of, in a sense, right? So that I'm just explaining, like that's why Bitcoin was so special, because people had conceived, you could have had digital-based money before that, but ultimately you'd always be trusting that particular, whether it's PayPal or whatever, ultimately you were trusting that institution was keeping the books honestly, and that was always a problem. Whereas again, with Bitcoin, the idea is no group of people, even if they wanted to, could,
because it's so transparent.
Right. And just the way it works, that it's basically just a giant, it's a public ledger, meaning it's just keeping track of all the Bitcoins that get, quote, mined into existence, and then just keeping track of who controls it, what addresses are, where are they located, in a sense, speaking metaphorically, obviously. And then the people who have the private keys have the ability to tell everybody, yes, I want to move this Bitcoin from that address over to this address over here. And that
shows up on the ledger.
Yeah, and that's why it's called blockchain, because it's just a block keeps track of all those new transactions and then gets added to the chain. So the chain just keeps growing, and you can just go back in time from when Bitcoin was launched, right? And so that's what the ledger, and there's thousands and thousands of copies of that ledger. Anyone can download the software and go ahead and grab the latest version, and they can have it, on their system. So that's the sense in which it's decentralized. You couldn't knock out Bitcoin. It's not like there's two computers somewhere where if you went in, if the FBI raided them, you could knock out a bunch of the computers, but there's still copies all over the place. It'd be like trying to get rid of Moby Dick or something. You can't. There's too many copies of it floating around, right? So that's kind of the idea. But to answer your question, there's protocols in place, and it uses a lot of math, fancy math, and so forth to how it works. But the idea is that only somebody who has the private key should be able to convince the network that, yes, I am the rightful controller of these Bitcoins, and that's why I have the authority to transfer them to somebody else. And so that's all that the ledger does, is just keep track of where these Bitcoins located in a sense. And that's, so if people started using that as something that was valuable, so that, oh, here, I'm going to give you my car, but in exchange, you use your private keys to tell everybody who cares about this thing that, yes, the Bitcoins are moving from that address to this other address that I happen to be the controller of, that I'll give you my car. Like, that's basically all that's going on. It's just people are giving valuable goods and services in exchange for moving where this ledger thinks these Bitcoins are located, when it all comes down to it. But again, the beauty is nobody is in charge of that. No one entity like has to be in charge, and we got to trust their integrity. Like, it's decentralized. And it's like the system can agree, yes, that's a valid transaction.
Now, my understanding is there was an individual who created it, but we don't really know who that individual is. There's a name. What was the name of the individual? That might all be metaphorical for Bitcoin. Satoshi, right? Yeah. And my understanding is that at least the creator or creators were coming from a more Austrian free market perspective of sound money. Is that true?
I mean, so on the one hand, so right, like people think that was a pseudonym and it wasn't the person, or it could have been a group's real name.
Like a John Galt kind of a figure.
Right. So on the one hand, because we don't literally know exactly who the person or persons were, we can't literally say, yes, we know by the time this person was 26, he was reading such, we can't make statements like that. But that's what I'm saying, that this whole literature of, leading up to Bitcoin, like, yeah, there's a whole tradition it was drawing on. And so, yeah, I think it's entirely plausible that whoever Satoshi was or group of people it may have been were influenced by those currents.
It seems like not too far of a stretch to say that they were probably or potentially influenced by sound money proponents like Mises and Hayek, Rothbard, et cetera. And then furthermore, it seems like the early proponents of Bitcoin, at least people that I know that have been were in on it even 10 years ago, a lot of those people were sound money types. They were excited about the idea of it. So it certainly disproportionately attracted sound money proponents that were frustrated with government fiat currencies. And
if I may,
go ahead.
Because you're right. I went off on a tangent that I hope was interesting for your audience, but I didn't fully answer the original. I didn't answer your original question.
It was all great.
What does sound money mean? So, in the context of everything I've been saying so far, so that you're right. When Bitcoin first launched, and if you go read the Bitcoin white paper, like the motivation given, it's things like basically trying to avoid ridiculously high bank fees and things like that. It was trying to come up with a low-cost way to engage in payments. That's the original vision that was spelled out in the paper, besides all the technical details of how could you actually implement this and do it. And so, like, somebody is working in the U.S. and they have family in Africa and they want to send remittances to them to go through Western Union or Chase Manhattan right now is crazy, especially if we're talking about small dollar amounts, how much they would slice off the top.
Transaction costs are very high. Yeah. And this cuts down on transaction costs.
Right. So, but then the other big thing too was the trustless nature of it, so that it was this protected system. And then just the way the Bitcoin protocol works is there's what's called the halvings with HALVE. It gets cut in half. That's what that refers to.
Right.
And so the idea is periodically the amount when what are called miners validate transactions that get awarded new Bitcoins, and that's how they come into existence. Right. So the total stock of Bitcoins that are like on the blockchain, like their location is specified on the blockchain, that grows over time, but the rate of increase tapers off until eventually it reaches 21 million. And then it's just 21 million forever onwards. And then people lose their keys along the way. So in practice, 100 years from now, there'll be fewer than 21 million Bitcoins, quote, in circulation, if you want to think of it like that. And so that's why it's incredibly hard. If people adopted it as a money, it would be incredibly hard, even harder than gold and silver. Right? Because again, the virtue of gold and silver is the government can't just flip a switch and create more gold. You have to go dig it up.
We could mine for it, but we can mine for it is the premise.
Right. And so, yes. And so that's the idea that, more gold will be mined. But also, too, like there's proposals that there's asteroids and stuff floating around the solar system that might have tons and tons of gold. And so, if we could get them, or, like in the Star Trek technology, like the next generation where like, make me a cup of tea and it just kind of materialized. Like you could just say, make me a kilogram of gold and it could just do it. Then gold would no longer be a useful money in that sense. Whereas with Bitcoin, it's mathematically determined. People talk about could quantum computing break that or whatever. But in terms of right now, there is a sense in which, no, it's mathematically limited, that they're only going to be 21 million. So that scarcity is built into it, which is a virtue when it comes to money. right? And that's a very Austrian.
That's very Murray Rothbard, to be very specific, is my understanding. And I know listeners most listeners won't even understand that. But Murray Rothbard's premise was we should have a fixed supply of money, right? And that's it. And well, correct me if I'm wrong. My understanding is that Murray did not, or Rothbard did not want any sort of additional increase in the supply of money.
Well, I mean, that may be an implication of it, but yeah, the bedrock claim was in terms of serving as the money commodity, any given stockpile or supply is adequate for those services. Just prices would adjust. So there's no, in the foil, what the point of emphasizing that was to bat down the idea that, we got to have a constantly expanding money supply.
Correct.
To keep the economy growing or something. Like people, that's a very natural thing for people to think, but the Austrian
deflation's bad. Deflation's really bad is the premise.
Right, by which
they
mean falling prices. Yeah.
Correct.
And so yes, the idea is, so it happened under the classical gold standard. It was basically as long as like the quantity mined of gold was kind of like the growth in the stock of money was roughly equal in the long run to the growth in other goods and services. And so that's why the purchasing power of the US dollar, for example, was roughly the same from like 1800 to 1900. Okay, so this idea that, things always get more expensive, that's a 20th century phenomenon. Back on the classical gold standard, that wasn't the case. $100 in 1800 could buy you basically the same kind of stuff as $100 in 1900. But that's because the stockpile of gold, they were mining new gold. But yeah, under Bitcoin, so yeah, it's a very Austrian view, and this is something that I address a lot, is that yes, it's not a knock against Bitcoin to say, oh no, it's a fixed thing, and so that would in practice limit the ability of the economy to grow. No, it's just that prices would fall year by year. If every year the amount of hamburgers went up by 3% and there's a fixed number of Bitcoins, then the Bitcoin price of burgers would gently fall every year. That's just what that would mean, and that's fine as long as everybody knows that's coming. And that's the thing too, is it would be very predictable under Bitcoin because they know precisely how much is going to be, quote, mined very rigorously ahead of time, so they can all make their plans accordingly.
So is Bitcoin acting as a currency or is Bitcoin acting as a commodity?
That's a tricky question.
That's a loaded question.
Yeah, so here I'm probably going to offend some of the Bitcoin fans. I've actually, in my sort of academic work on this stuff, I've said, given the Misesian taxonomy of types of money, so he's got commodity monies, which things like gold and silver, but just in general, like if you use cattle or something like that, basically anything that had some other purpose before it was adopted as what's called a medium of exchange and then became a money, that's a commodity money. He also had this category called credit money, which is kind of a niche thing I don't think we need to worry about. And then the other one was fiat money. And the essence of fiat money was not government issued coercively. That, in terms of the classification, he was saying, no, it's that there are some authority figure that issues it, specifies these are the characteristics that make this official versus other things. So like rectangular green pieces of paper, there's very specific but somewhat arbitrary reasons why, this is a legitimate $100 bill versus no, this is just something some guy did on his laser printer. You know what I mean? Where intrinsically there's not that much. Whereas if you have an ounce of gold and someone else has an ounce of gold, you don't need to say, oh, wait a minute, was this stamped by the mint? Otherwise, This isn't really money. Like, no, back on the classical, gold was gold. And as long as it really was an ounce of gold, it didn't matter what its history was or what markings were on it. You could take a bunch of coins or jewelry or whatever, melt it down, and then restamp them in coins and you're fine, right? So anyway, I'm just saying with that classification, I said, I think technically Bitcoin would be called a fiat money. In that, if it became money, I should be clear that, remember, to be money in the Austrian view means it's got to be a medium of exchange that, at least among a certain community, is almost universally acceptable. So we can argue, I don't think Bitcoin is yet there. Like, it's definitely a valuable asset that has many money-like qualities at the moment.
But it's not quite. But it's not quite a currency, is what you're saying at this point in time,
or money, I would say,
or money. Okay,
I'm sorry to be. It's just.
No. I appreciate
people. Yeah, there's a lot of fine distinctions people make, and that's more.
Thank you.
I don't want to get yelled at by people in the comments. Yeah.
One of my pushbacks on Bitcoin as a money, and thanks for being precise with our language because I think that's extremely important. One of my pushbacks on it being a money, part of it has to do with just the wild gyration of the value of it itself. And so there's a lack of trust that exists because if I go in to buy, say I want to buy a new car and I need half a Bitcoin to buy a new car, the value of the Bitcoin could literally decline by 10% while I'm driving my old car to go get the new car. That can happen, right? It's a relatively volatile asset class. So there's characteristics to it that I think don't always fit the money bucket, because I think one of the things that makes money palatable is that there's tends to be a stability in the price of the money. I know it can go down over time or it could theoretically go up over time, but there is not as much standard deviation within that asset class. And so I think that's a challenge. And I'm not saying that Bitcoin can't eventually, or Ethereum or other cryptos can eventually take on the properties of a money, but I don't see it from a volatility standpoint. How do you feel about the standard deviation, the volatility component of it? And does that even matter?
Oh, it definitely matters. Right. So I agree with everything you said, that right now, one of the hindrances to more widespread adoption of Bitcoin is just what you said, that when you're holding it on your balance sheet, yeah, there's volatility. There's a lot of risk involved. And so it's kind of like a self-fulfilling prophecy that means more people don't want to hold it. And then that by limiting it or going the other way, I've argued that as Bitcoin adoption grows and more people start holding it, I think you will see the volatility in the day-to-day price go down. Right. So I definitely think the volatility over the next 10 years will be lower than the volatility in Bitcoin's price over the prior 10 years. And then that's kind of like a snowball effect, that it'll be less risky to hold it. And so I think more people will put it into their portfolio just like as a hedge. And it's another sort of paradox is that right now, I'm sure you've heard of the hodlers, HODL, which is like apparently a typo. People were trying to say hold and they just flipped it. And so now it's become the thing that meaning, a lot of people, their motto is just get some Bitcoin and just never sell ever. I don't care if your mom needs a kidney transplant. You do not sell. Never.
Yeah.
And you say, why? And you say, because in the year 2050, Bitcoin's going to be the money of planet Earth. You say, okay, but if that is to happen in 2050, then people have to be buying things with Bitcoin, right? Well, yeah, because it's going to be the money. And so, okay, so you have to give it up in order to, you know what I mean? So there is this kind of weird thing.
It's a paradox.
It's soluble. Like I've written, I've done a lot of stuff on this idea just to show this, like there's nothing contradictory, like in terms of how it would play out over time, but it can't be that everyone just holds it all the time and it's money. Like it's, what I think happens, just to not tease your listeners and leave them hanging, is that yes, the early adopters, the people who forecast that's going to be the case in 30 years, if they're right with all the stuff, your anticipation had to be correct. Otherwise you're distorting things. By them hodling right now and trying to get their hands on as much as possible and holding it, they're driving up the price. That might bring other people in the market just for trying to get the gains. But then as that adoption tapers off, like as more and more institutions hold some of it, and then you kind of reached everybody you're going to reach, well, then those 30% annual gains are going to taper off. And then at some point, somebody who's worth $20 billion might say, I'll sell 1% of my holdings and go buy a private island for my girlfriend. You know what I mean? I'm exaggerating, trying to be funny, but
sure.
My point is, at some point, even the most diehard hodlers, I think, would have to admit that, yes, it's okay. I'm not violating my principles if I sell some, quote, take some gains, because what's the point of hodling if you literally never sell? And so that then it would transition. And then once people started releasing they're like stockpiling it to capture the price gains. But once those gains have been largely realized, they can start releasing it to everybody else. And then it would become, like a reserve asset, or it probably wouldn't be a day-to-day currency in terms of buying a cup of coffee, just because even there, the transaction costs would probably be high unless they alter like what's called the block size. So can I say one last thing? I don't want to lose the train of thought, that I didn't mean to be suggesting that in our day and age now, the only thing that can be sound money is Bitcoin. There's other stuff too. Like you could have digital tokens on other types of blockchains that point to like a bar of gold that's stored in a Swiss vault or something. So I'm just saying there's lots of things.
Absolutely.
Like that.
I appreciate the distinction. And look, Bitcoin has kind of taken us by storm, and you can see the evolution of money over time. Again, I'm not even calling it a money, but I'll contradict myself a little bit and say you can see the evolution over time. I mean, in the Caribbean, they used to use seashells and they used beads in Africa as a type of currency. And then we got into, commodities and gold being used. And you see the evolution of money over time. And is this the next evolution? And it certainly seems like it is. Last comment I'll make, and then I want to transition to the Genius Act, is as someone who manages money, I look at the way people respond to different asset classes psychologically, and the way in which people respond to Bitcoin feels a lot more like the S&P 500 or even a hedge fund than it does like money, right? I mean, even the idea of the hodlers, they're paradoxically, even though they view it as a currency, just to distill your point, they're owning it the way you would own maybe an index strategy or you'd own a basket of stocks, right? The idea is buy great investments, own it for the longer term. Nobody talks about cash that way. Nobody talks about money that way. They may hold money for long stretches of time, but no one comes under this illusion into my office thinking, well, we'll buy a lot of money-based assets like money market, expecting significant price appreciation. They're happy to clip off some interest on top of it, and that's about it. So just the psychology around Bitcoin hasn't quite met the money phase, but maybe it will in the future. Nonetheless, I want to get into the Genius Act because one of the things I've noticed with cryptocurrencies, there's been an immense amount of regulatory uncertainty and ambiguity, and we finally got the first sort of major piece of legislation around cryptocurrencies, specifically stablecoins, which we'll get into in a moment. But what's your initial take on it, Bob, on this new act that was passed recently?
So I'll try to keep my answers brief because I know you have a lot of follow-up questions here that we can unpack things. So I definitely am glad that they did something. So for your audience who doesn't know me as well, like I'm a radical libertarian, you would say. So in general, I don't like the government getting involved in anything regulating commerce. I wish it would all be open. But given that we do have these authorities that are doing things and that people know, well, if I build something and the authorities decide they don't like what I did, I can go to jail or they can tax me or they can do all sorts of other stuff. And that wasn't just a hypothetical threat. Under the Biden administration, they were very hostile to people who were innovating in this, let's call it blockchain-based finance to kind of have a big bucket.
Unless your name was Sam Bankman-Fried, which is a true story.
Right.
And then the regulators were talking to him.
Yes. And I think there's obvious reasons why that the innovation in this space threatens a lot of the established interests. And by its very nature, it might be harder to control. And so I think, a lot of people in the Biden administration tied to them liked having control over the economy. So my point being that the Genius Act, I think, fit in with Trump's promise when he got, won re-election to say, we're going to make the United States the crypto and AI capital of the world. Like that, this was part of that. And just giving regulatory certainty, I think, regardless of the specifics, was a huge win. It just sort of gave the green light to companies, people that I consult with, and it's in this space. I participate regularly on the so-called X spaces, where with people who are doing blockchain-based things, that it just sort of gave the green light that yes, the authorities want us to be doing this, and as long as and they're just telling us this is the way to do it legally and in compliance, and that's kind of what you're going to be sinking millions of dollars that you've raised from investors. Everybody involved wants to know, is this compliant? You know what I mean? Like we don't want to be doing something that the authorities are going to come down 2 years later and say, "What are you doing?" So that's in the sense of that, and it was pretty straightforward. And it's like, okay, these are the rules. Let's go ahead and start building.
I believe it was Coinbase, the CEO, and I don't remember his name. It was Coinbase or Binance. One of them, this is a couple years ago, flew down to Washington, D.C. to meet with the SEC chair at the time. And he's like, I couldn't even get a meeting. Like, here I am, the CEO of one of the largest crypto exchanges on the planet, and I'm not being hostile. All I want is a dialogue with the SEC to work collaboratively together. He's like, they wouldn't even give us this was, he was on a podcast and I was listening to him, and I was like, they wouldn't even talk to us. And so that type of ambiguity around the regulatory environment, I think, really stifled innovation at the time. And so I'm with you. I think this is a win, right?
Yeah. And there were other things too, like if people just go Google like Operation Choke Point and then Operation Choke Point 2.0, like stuff has been coming out with like FOIA requests, but also just with the new administration and people like releasing details of stuff where, yeah, this was off the top of my head. I don't want to say more because I might botch the details, but stuff like Elizabeth Warren really, had certain people on her hit list and they were doing things behind the scenes and stuff that on the surface looks suspicious, but you didn't really know. And then now we're getting more details. So Caitlin Long is somebody who's been documenting a lot of this stuff. If people want to go look her name up, that she's been reporting on these things because she also had a run in, like she was trying to establish a bank that had 100% reserves on certain crypto assets and she just couldn't get approval. And it was like, what's going on? And so now it's coming out as to why. I know another guy I won't name, but he ran a pretty big scale mining operation, Bitcoin mining. So he just had, warehouses with supercomputers in there that just solved math problems in order to mine Bitcoins. And he just, like his normal banks, like he had trouble just banking with regular bank, with his business checking accounts, you know what I mean? And so nobody sent him a letter or anything, but he's pretty sure that, this is just, they had various ways of just trying to chafe and limit people during the Biden years. And now it's like, hey, we're open for business. We want you to do this. It's just that changing climate is huge. But in terms of the specifics, stuff like the Genius Act, to answer your question, Drew, I think, in the grand scheme, I would take that. Yes, that I was glad they did that, rather certainly compared to doing nothing and just talking.
Yeah, and I want to dig in kind of a philosophical question around regulation, which I'll do at the end of this. So you're getting into which I appreciate, and I'm going to come back to this point. Can you give the audience just like a really quick snapshot of like what did the Genius Act actually establish? And explain stablecoins if you don't mind.
Yeah, probably. I was going to, you anticipate. I was going to say, why don't we first explain what's a stablecoin? So a stablecoin is different from something like Bitcoin, and I'll try to just keep it high level. So the similarity is they both use blockchain technology, okay? But a stablecoin, it's a token that resides on a blockchain. It's the same type of principles that the community can validate who has the authority to move one to the other, that sort of thing. So you've still got that level of the transparency and the trustlessness of it, depending on the structure and the issuer. But the idea is that by its very nature, a stablecoin's market value is supposed to be stable relative to something else. And so the most popular examples right now are US dollar stable coins, right? So the point is that if you have, one, like a Tether's big and USDC is another one. If you have one of those, the point is their market price is supposed to be anchored towards $1 US, as opposed to Bitcoin, which is all over the place, as we've said. And so where the rationale for this, because when I first heard about these things,
it feels contradictory, Bob.
Exactly. Right. I actually thought, what the heck, why would anyone want this? Like, I thought the whole point was, and like we were saying, like the early people who were really happy about what Satoshi's white paper and getting into Bitcoin, a lot of them, you were right, Drew, were real big, like libertarian types.
What are we doing?
Yeah. And so, because they didn't like the US dollar, they didn't like government dirty fiat money. This was this hard money that was outside of the government's clutches. And so then to say, why don't we take that technology that was invented for Bitcoin, namely blockchain-based tokens moving around,
right?
And why don't we do something similar, like on a different chain, but instead we're going to be keeping track of things that by its very construction will be worth $1. And so even if there's hyperinflation, then your stable coins will be worth exactly $1, and that can go buy you, a thousandth of a loaf of bread now, right? So that does seem kind of weird, but the rationale, the market demand for it is more and more people got big dabbling and holding portfolios in their wallets of various cryptocurrencies like Bitcoin and Ethereum and, some of the other more niche ones. There'd be a lot of volatility. And so they might want to, quote, go to cash, right? So even though everybody would say, we want to get to a world where everyone thinks in terms of Bitcoin, that we're not there right now. You got to pay your rent in dollar if you're in the United States, in your groceries. And so the idea was, if you had holding a Bitcoin, let's say it went up 200%, but you didn't, you were worried, like, I want to lock in some of those gains or just take a break, that instead of having to sell it and then get US dollars wired to your conventional checking account and everything is a huge pain, instead, isn't there a way I could keep it in the crypto world, but get it over into something that's not volatile? So that was the function of stable coins, because they're the same type of thing. It's just you trade your Bitcoins to somebody else and they give you a bunch of stable coins in exchange. So you're still in that dimension, or whatever you want to say, that plane of existence financially. But now those things have a built-in feature where they maintain their value, their value vis-a-vis the US dollar. They have ones for the euro and stuff like that, depending where you live and what money you use in your day-to-day life. Right. So that's what their purpose is in terms of the economics of it.
And I guess that makes sense, because if you think about it, everything's denominated in terms of the United States dollar, right? Like you go to the store and you buy a loaf of bread, you're not there. I mean, I've seen a little bit of this with Bitcoin, but it's still 99.9% of it is going to be this loaf of bread costs $5, $5 US. And everything I do in the world of investing and finance, it's never like we're wiring 50 Bitcoin to the private equity firm for the client. It's no, we're wiring US dollar denominated to that specific, whatever the instrument is, a private equity, private credit, or even a mutual.
Yeah, and I'm guessing
everything's
too,
denominated in dollars.
And even, right. And even if you have merchants and stuff that would be willing to accept Bitcoins, like if somebody wanted to hire me for consulting services, this happens. There's a guy pay you in Bitcoin. Sure. But it's not that I quote and say my hourly rate is this many Satoshis, which is a unit of, you know what I mean? Like it's quoted. So you can give me, at the moment you send the thing over, we check what's the market, what's the US dollar Bitcoin exchange rate at that moment. And then you give me that many dollars in Bitcoins. And I'm happy to do that. Yeah.
I guess I would describe it as a unit of measurement is the dollar for all assets right now. And that's just the way it is. That's the unit of measurement. So for you look at it and you're like, well, if you're going to pay me $20,000 to do this consulting gig and it's going to come in the form of a Bitcoin, I'm going to make sure that the Bitcoin's worth $20,000. That's just the way society is running at this moment. And that is subject to change, of course. And
again, and the reason is just because my bills are that way. In other words, like if I wanted to have $20,000 more of Bitcoin, I would just take $20,000 and go buy some Bitcoin. You know what I'm saying? So like on the margin right now, my Bitcoin holdings are what I want them to be. And so anyway, it's different. Like I will just take it and hold it if it's like, because I'm not planning on just some random person emailing me and wanting consulting services. So in a sense, it's like bonus that I just keep on the side. But you get what I'm saying.
100%.
So with the stable coins then, yeah, so that is what arose. And then what's interesting though is there were various, I'll just say just a tiny bit about this and we can take this where you want, Drew. But so, okay, now that you know what's the function, like that's why they're called stable coins, is they're supposed to maintain their value. They're supposed to be stable vis-a-vis some other benchmark, like the most popular case is now being the US dollar. And so, but how do they do that? And so one obvious mechanism is if you have something backing them up, which is totally different. There's nothing backing up Bitcoin. Bitcoin is not a claim on something. If you have Bitcoins, it's not that you can turn them in and get them redeemed, whereas some types of stable coins.
It's a fiat, right? I mean, I think you said that earlier.
That's why I was calling it fiat. Yeah.
And I think that's accurate. That's just precise.
Whereas a stable coin, at least depending on its nature, might not be fiat. It's like a claim. And so the ones, like some of the most popular ones, they have redemption features. And so when you say, well, why would these things maintain their value to the dollar? It's because, if they dip below it, like if they started trading at 95 cents, in principle, somebody that was big could go acquire a bunch of them at 95 cents each and then go present them to the issuer at par. So the issuer stands prepared to redeem these things, like to pay you in dollars, like through conventional bank accounts and whatnot. You know what I mean? If you present to them 10,000 of their stable coins that are supposed to be pegged to a dollar, then they have to wire your bank account $10,000. It might take 3 days to hit and everything, but you see what I'm saying? So and then if you think through the economics of that, so that would withdraw the stable coins from circulation, shrinking their supply, and that would tend to push up their unit price, right? So it's kind of like the classical gold standard mechanism. If there's the redemption play, there's another possibility where they have what's called algorithmic stable coins, and those are the ones that you remember a couple of years ago got into trouble with the Terra Luna and stuff. And there, the idea was, just real quickly, that might sound really nutty to people. Like, well, they're not backed up by anything. They just had all these complicated schemes by which, if there were mechanisms in place such that if it is trading below par, there were ways that it would just destroy some of the stockpile, or on the vice versa. If it were trading above par, then they would have the permission, the ability, the protocol would allow them to mint more and to pull. You know what I mean? So that was kind of the way it worked. It was supposed to be like an elastic, like accordion stockpile.
Sure.
But the problem is just in practice, there were a few famous market meltdowns where it didn't quite work. Like the thing just kept dropping like a stone, and the ability to destroy it didn't quite work. And so people kind of got burned on that. And now they went, no, I want it to be actually, there's assets that are worth dollars backing these things up. So anyway, so that's just kind of the broad outlines. And so that was the context of now the Genius Act.
Stablecoins. Yeah.
Yes. So the Genius Act, just some of its key features, it was saying, it's saying for people who want to issue stable coins to people in the United States, obviously that's the jurisdiction. So it was saying it's got to be backed up by something, and it, in it's got to have 100% reserves, because that was one of the big things is stablecoin issuers could say, oh yeah, we got it backed up. And look we got some mortgages, you know what I mean? Like, it's one thing to say you've got a pool of assets, but if it's like allowing for a bank run, maybe I should say at this point, there's many respects in which stablecoin issuers are kind of like a bank.
Yeah.
Right. And I don't think that's like economically, like there might be some other particulars in terms of the legality, but economically, that is kind of what they are, that people would give them assets and then they would give them claims that could be in principle redeemed. And sort of like if you go and put $1,000
feels like a bank
in currency into your Bank of America checking account, you're not walking around town saying, oh, Bank of America owes me $1,000 and I can buy things if the community is willing to accept claims on Bank of America as if they're the same thing as $100 bills, even though they're kind of not. And so that's kind of what stablecoins became, is once they got bigger and bigger and more people started using them, they realized the convenience. Like I said, people who were in the crypto space, instead of having to go back and forth between like traditional finance and having money in a checking account with Wells Fargo, but no, you just keep it in crypto stuff, then there you would just go back. So these stablecoin issuers realized that, more and more people now are holding Tether and USDC and whatnot, and they're not presenting them to us for redemption. We have to always be prepared to do that just so the public trusts us. But so you see how that's kind of like a regular bank, and they can get away with what's called fractional reserves.
Yeah.
As long as the public trusts that, no, I can just go in and empty out my Wells Fargo account and get $1,000 in cash. I don't need to. But then Wells Fargo, knowing that, can make a lot of mortgage loans and things like that, and knowing, oh yeah, if at any given time the community showed up, we don't have enough in the vault. It's not that they're insolvent. They have assets on their books, but they're just illiquid. They might have 30-year mortgages backed up by people who think I could just show up tomorrow and take all my money out. Right. So
correct.
Right. So that's what the Genius Act was coming in and saying, we don't want that. We want to give certainty. We're saying if you're issuing stable coins that are supposed to be US dollar denominated, the saying this is basically entitles you to $1. Not only do you have to have enough assets backing that up and 100%, but they specified the type of assets that could qualify as reserves. And it was really particular. It was stuff like literal checking account balances with, FDIC insured banks and things like that. Or it could be treasuries. But even there, it couldn't be a 10-year treasury. It had to be treasuries that had 91 days of maturity or less. Okay, so it was really short-term, very safe, dollar denominated, or it could be like money market funds that consisted of those things, right? So, but you get the point.
And we just went through the Silicon. Yeah, and I think in the wake of the Silicon Valley Bank failure, where they were loading up on 5 and 10-year treasury notes to be safe, they ran into a problem. So I can see the incentive behind, hey, let's make sure they're using shorter-term notes, right?
Yeah. So it's ironic because this was a huge controversy, like theoretically among like libertarians, especially people from the Austrian school, about arguing about fractional reserve banking. And so everybody in this debate, in terms of my colleagues and whatnot, that we don't like central banks, right? Because that's coercive and the central bank comes in and gets its way through coercion. But the academic sort of theoretical question was, in a totally laissez-faire environment, would banks that offer checking accounts, what are called demand deposits, would those things tend to be close to 100% reserves? Or would they be much lower, perhaps, if that's what the clientele wanted? And then economically, is that a good thing or a bad thing? Or is that stabilizing or that's the kind of stuff we would argue about. And so with the rise of stablecoins in this largely unregulated environment, it was kind of a neat test case to see what's going to happen here. Like, are these stablecoin issuers, is public pressure going to demand that they keep close to 100% reserves in very liquid assets? Or, could they have real estate in Dubai or something? And that's what's backing up, you know what I mean? When that's kind of not really. So on the one hand, like it was with this Genius Act, I was a bit like, oh, well, now we're not going to have the test anymore because now the regulators are just imposing it. You know what I mean? Because I was on the 100% reserve camp. I thought market forces would push the stablecoin issuers to have high ratios of reserves with fairly liquid. But anyway, now we don't know.
Libertarians said on the other end of it too. In fact, I remember being in graduate school, I took a seminar on monetary theory, and that was a big debate in the class. And there's actually relatively free market folks that did not subscribe with modern day central banking, but they thought that the market would bring about fractional reserves. And so
I used to be on that side too. I flipped. But
interesting. So, That's a discussion for another day. I'd love to hash that out.
So I'm just saying it's forth. it's ironic here that I'm saying it was funny just how much this was like right in the midst, like it was like my academic past and my current day job selves merged into one, because the stuff like when I'm doing these X spaces, I'm explaining like the logic and the theory of free banking and blah, blah, and it's like, yeah, these stablecoin issuers, they're kind of like banks digitally. So that's what I'm saying is
it became real. It wasn't just theoretical anymore.
And that's the point I was making is it's kind of funny that you had all these regulators and saying, oh, we got to impose 100% to protect the public from these wildcat stablecoin issuers when they were imposing regulations on them that were way stricter than on the commercial banks.
Correct.
You know, it's like, oh, so if you need to have 100% reserves in things that mature in 3 months or less, then I guess every commercial bank right now is wildly irresponsible because they're giving 30-year mortgages. What are you doing?
Welcome to the club.
So
yeah, no, it's super fascinating. So generally speaking, it seems like you have a favorable opinion to, in many ways around there being some regulatory certainty. What are some of the unintended consequences to say the Genius Act in your estimation?
Okay, well, another main element of it is it prohibited the payment of interest to the end user, right? So before this act came around, like I was, like at Infineo, where we're, as you know, Drew, taking life insurance and putting it on the blockchain.
Sure.
We started thinking through, like theoretically at first, but then with the aim of down the road, we might try to launch a product like this, of having a stablecoin, USD stablecoin that was backed up by life insurance cash surrender value.
Very fascinating.
Right? So, so to give an idea of people that kind of mobilize their assets and be able to effectively borrow against their policies, at a lower rate than just going to the carrier. That would, that'd have to be true to make it make sense. But then we're trying to think, well, okay, if we have this relatively new type of stable coin and life insurance cash value, some people know how that works, but some people don't. And we're approaching large institutional holders of other types of stable coins that are back tethered, like the big market ones that everybody knows what they are. And I was thinking, well, how can we break into that market? And I said, we could offer them interest. Like to say, so the way it would work is like, if you're holding 100 of these stable coins issued by the Acme Corporation, backed up by some novel asset, whatever it is, it's each coin still has to be worth $1. That's the whole point. But what we'll say is every year we'll give you 5 more coins if you keep your holdings of our thing. So it's like there's interest it's sort of like getting interest on a checking account, right? If you keep your funds parked at bank A versus bank B. So that's the kind of thing. Like, yeah, you want to hold USD denominated stable coins, but you have a choice. There's competition in which particular stable coin do you want to hold it. And so I thought clearly what's going to end up happening in terms of market competition is they're going to start offering interest to their customers. Again, the unit is still trades at par. That's the whole point. But like you get more awarded to you if you hold the thing. But the Genius Act prohibited that. And they said, no, you can't. But I think, so there's like a benign explanation and then a cynical one. So the benign explanation is they wanted to just make it feasible. Like you can't insist on having 100% reserves on things that at best are T-bills. Like there's not much rate of return the stablecoin issuers can, much juice they can get out of there. So how can they pass through interest? So it's kind of like just to keep things straightforward that if we're going to insist on this high level reserves that you can't be passing anyway. So maybe they're just trying to forestall that. The cynical explanation is I thought the major banks, like conventional banks, were involved with this whole process and they realized, these stable coins, like there's a sense in which that's kind of like banking, online banking.
Yep.
And that challenges our business model.
It does.
We can't stop it. It's too big at this point. We can't. So what can we do to buy ourselves 10 years so they don't just put us out of business is let's make it that they can't pay interest to their customers, whereas we can. Right. So that's kind of and let's insist that they keep 100% reserves and things that are like T-bills or even more liquid. So I think they kind of put a box around it. Like here's stablecoin issuers. Here's a sandbox you can go play in and do your stuff. But you're not threatening us because you can't really compete with us. You can't be earning money on the back end by investing in longer term assets with a higher rate of return. You can really only take your customers' funds and put them into T-bills or checking accounts. And you can't pay interest to your clients, right? So I think they kind of locked in the ability of that to penetrate and to really compete against online checking.
So one of the things I've been thinking about, and I have a couple just other quick questions I do want to transition to AI with you as well, but one has to wonder, will traditional banks start to see the writing on the wall that they need to implement this technology? So it's like adapt or die. Do you think there's the potential that major institutions like the major commercial banks that borrow from the Fed, do you think you could see a major change in that landscape where they know like, hey, we're going to have to start to play ball in this crypto space or stablecoin space, or we are going to be sent packing, especially around the transactional cost piece, because this is providing an immense amount of competition because it's so much cheaper to transact through crypto than it is through the traditional banking system. So do you see a future where the banks are going to really change, or could it lead to their extinction one day, looking 5, 10, or further years down the road?
A little both. I'm being a good economist here. I'm just trying to be wishy-washy and give you all answers.
Yeah, I'm sorry. I'm asking you to peek into the future and let me know exactly what happens, because you are Gandalf, by the way.
Yes. Thank you. So you already do see the big players are getting into this space. Various, they're offering ETFs of Bitcoin and things like that. So this is becoming much more of a standard thing that the major financial institutions are getting divisions, at least, that are in blockchain-based finance, right? And so again, I think it's just because there's going to be a snowball effect where right now it's still the case that like asset managers might literally be prohibited from having an allocation to Bitcoin. Whereas I think 5 years
I can't recommend it. By the way,
yeah.
I cannot recommend it regulatorily. Like it's
right. So I think,
but that's going to change,
right? Because, and not just because of like cronyism or something, but because the fundamentals I think will change. Like we said, like in 5 years from now, instead of it being like, oh yeah, Bitcoin might go up 80%, but it also might go down 30% next Tuesday. Yeah, as an institution, you're managing a pension. You can't have 30% in that. That's crazy. But
correct.
As the volatility comes way down and it just becomes more of a hedge, and it's kind of like, it'll be more like gold. That I think as Bitcoin starts to operate and behave more like gold, it's just more convenient to move around and stuff.
Sure. Then
I think that, because you don't have to store it and things like that, I think that problem will largely solve itself, and those covenants will be relaxed and charters and so forth. More people will be allowed to have exposure to it. So in one sense, yeah, the major financial institutions already are adapting in the sense that they've got people on their staff who are into like, digital finance and whatnot and alternative asset classes. And they're, saying, guys, this is the wave of the future. We got to get into this. So you do see that in terms of like just still their basic business model of, yeah, like how much do you have in your Bank of America checking account ultimately depends what their computers say. Like they're keeping track of that. Like you can dispute it and they have mechanism, but ultimately,
yeah,
they are in charge of telling you how much they owe you. Whereas again, with true decentralized blockchain, that's not the case. Nobody is in charge of it. And so I don't like, in a sense, to fully transition to that, they would be putting themselves out of business, at least if what you mean is their old way of doing business.
Yeah. Yeah. I think a lot is going to change for sure. Quick question. Secretary Scott Bessent said that there will be a greater demand for treasuries as a byproduct of this act, and just with greater regulatory certainty around what stablecoins are. Do you agree with that statement? And like, why do you think he's making that argument?
Oh, I absolutely agree with it. And in fact, that's, again, part of like the benign versus cynicism. Just think about what we said that before. I thought had it been left unregulated, like in probably the perfect world, certainly they would have said, so long as you don't violate contracts with people and so long as you don't lie to them or whatever, then
that's never going to happen.
Yeah, right. Then go do what you want.
Yeah, but that doesn't happen.
Right. So that wouldn't have been it. But compared to that benchmark or that regulatory regime, again, I think what you would have seen is some stablecoin issuers would have operated on the scale of, hey, you wire us funds, like you give us conventional dollars somehow, then we go and buy assets with that, and then we issue you stablecoins that are our tokens on the blockchain that we run and whatever. And then we pledge that we're going to keep it. And if you want to redeem your stuff, you can. And we can be in riskier, longer term assets that have a higher rate of return. And in exchange, we'll pass some of that earning on to you and share it with you, the customer, right? So that's kind of like, like if you want to have a checking account that pays interest, the bank can't keep your currency in the vault 100% because how are they going to pay you interest? They need to go lend it out to people, right? So that's the spectrum of the risk reward for the client. And I'm saying in that environment, then the stablecoin issuers who were operating on the riskier end allows for the payment of interest. They wouldn't be buying treasuries. They certainly wouldn't be buying T-bills because there's no yield there, right? They would be buying other stuff. So I'm saying here, what the Genius Act does is it insists this entire space, if it grows to, as more and more people want stablecoins, is that then to the extent that grows for that, there's people want that, they want to hold those because it's more convenient than other types of dollar-based assets, then there has to be a one-to-one demand somewhere else. Somebody's holding treasuries to back those things up. So they've just automatically built in, like if you think the growth of USD-based denominated, stablecoins is going to grow by 5 trillion over the next 10 years, you just guarantee that there's going to be 5 trillion extra in demand to hold treasuries because someone needs to be holding those. So that's what I'm saying. Yeah, they built that right in.
Which may further entrench the United States dollar as the world's reserve currency as well. You can kind of see a lot of downstream effects from this.
Yeah, but just to be clear, those are two separate, I think they're both true, but just those are two separate claims. So the one is they're building in demand for treasuries.
Yeah.
And then the other is they're fostering the continued dominance of the US dollar as being like the medium of account that people have in their heads when they're doing global transactions.
Okay, good point. Very good point.
And I think it does both because it's making it now a stablecoin. As more people issue stablecoins, it's just going to become more commonplace. You know what I mean? As more and more people are using stable USD denominated stablecoins or pegged stablecoins, it's just going to be the thing to do. And so, yeah, I think that is going to further just people are going to use, that's going to sweep the globe as opposed to a euro-based stablecoin or even like a gold-based stablecoin thinking. And so, yeah, that will help them get their foot in the door for people as more and more people move into blockchain-based finance. If the biggest game in town is Tether or USDC or whatever, that's, I think, just going to lock in first mover advantage. More people are still going to be thinking in terms of dollars.
Okay. So I do eventually want to get to AI, but I have one other comment for you.
Yep.
And on time, if I take another 20 minutes, is that okay? Or do you have a hard stop, Bob? Okay, great. I appreciate it because I really want to talk to you about AI. One comment that I had was, I've thought a lot because I definitely fit within the free market camp, but spending, and I don't know, Bob, if it's just hitting middle age and becoming a little more practical about life and you spend a little bit less time kind of in the academic space or in the ivory tower. But I used to spend so much energy kind of pushing against all types of regulation. And fundamentally in the ideals, I call it the world of forms if you want. Yes, in the perfect space, society functions well and we're not needing regulation. There isn't the state to have to force it. But the reality is there is a state. The state isn't going anywhere anytime soon. We have to live in practical reality. And I oftentimes see these debates where people push back against all types of regulation because they feel like they're sort of caving or they're acting like a heretic and they're not being true to their ideals. But that's where I think sometimes life becomes super paradoxical, where it's like, yeah, in theory, I would love a free market banking system. I think it would be better and healthier. But the reality is that we operate in the real space right now today. I work in the financial markets. And sometimes there's so much damage with no regulation or no certainty. And you touched on this at the beginning. And I guess my thought on this is, are there moments, even for someone who's quite libertarian like yourself, are there moments where you're like, hey, look, in the ideal, we don't want regulation. But we also are living with true constraints, and a little bit of certainty around regulation certainly trumps just absolute ambiguity that existed with cryptocurrency. And you kind of touched on this, but how do you feel about those statements of maybe as free market folks leaning a little bit more towards practicality? Doesn't mean you're sacrificing your ideals. It just means you're trying to operate in real time and space.
Yes, 100% to those sentiments. And I think partly too that, yeah, when you're younger, like my 20-year-old self might look at my current self and think like, oh, you're a sellout or something. You know, I don't know.
Right.
But certainly he'd be wondering like, how'd you put on so much weight? But but on the other hand, I think part of what happened is my 20-year-old self just thought, it's just a matter, people don't see it the way I do. And if I could just explain it to them, then the older you get, you realize, A, like some people maybe just aren't that bright, but also B, I think there's a lot of people that there's this phrase, willful ignorance, that when I was younger, I didn't understand. And it's like, why would you be willfully ignorant? I can understand being ignorant, but why would you on purpose? And then I realized, no, there's plenty of people right now that they know this is what I want the answer to be. And they just come up with arguments after the fact to, you can knock down that argument and they'll switch to a different argument. It doesn't, it's called what's called moving the goalposts, in online arguments. So just the more you see that, you just realize that, that you got to take your partial victories and always compare stuff to, yes, you can have your perfect benchmark. This is how things would operate in a perfect world. That's not going to happen. So in a sense, it's kind of silly if something comes along that's a huge improvement over the status quo and you object to that and make that not happen because you're holding up something else. I would say you don't want to make the perfect the enemy of the good, except usually when people say that, it's because they're pushing something that I think is awful. So I don't want to say,
right.
Usually that's a thing for like, here, take this horrible thing because so anyway, that's my long
spirit of Voltaire when he said that was truly like, don't make the perfect the enemy of the good, because then you get nowhere.
Yeah. So that's the sense in which, when people ask me about the genius egg, and you just saw how I have like lots of cynicism involved and where I think
but you're nuanced.
But still, I start at the beginning by saying, yes, if it was nothing or this, I'm glad they did this. I would take this in a heartbeat over nothing.
100%. I appreciate that.
Could I have written a better bill that I was? Sure. And, and my 20-year-old self was like, what are you writing bills for? No, you just got to say, no, people used to say, what would you do if you were Fed chair? And my answer was, I would resign, right? Because that's the pure thing to do. But on the other hand, does that mean if the Fed tomorrow wanted to tie the dollar to molybdenum, that would be a good idea? Well, maybe not. Gold, that's a much better idea, right? So you see that, I can sit there and comment on better and worse ways for the government to do things, even though I wish the government would decentralize and say, you know what? Our mistake. Why don't you guys figure it out voluntarily?
The irony is that oftentimes people that maybe hold really good, truthful principles abdicate from all institutions because all institutions are bad. And literally the world drifts in the opposite direction of where they want it to go. And that's the rub. And I'm just willing to engage the system in a pragmatic way of saying, hey, can we incrementally make money sounder? Like, let's do it. And by purely abdicating from all institutional structures, what they're actually doing is waving the white flag and allowing the system to further devalue and move our currencies to a worse place. And so I don't want to play that game. I'd rather us be engaged. And listen, it's politics, and politics is truly the art of the compromise to an extent. So let's talk about AI.
Just real quick, another example of that whole phenomenon was like with the tariffs, right? So I would not let Donald Trump teach a homeschooling class on international trade. He doesn't know what he's talking about. He's talking about trades. However, I've seen some of the knee-jerk libertarian reactions to proposals for tariffs, and they're saying things that are demonstrably false. And so that's, I was trying to be more nuanced and say, look, if they could slash spending 90% and have tariffs phase out income taxes, I would take that in a heartbeat and then go through it and everything. So as opposed to just, well, no, tariffs or taxes are bad. It's like, well, they're going to tax us. And so the question is, is there a way? And so given that there's momentum and a lot of people are on board, can I offer commentary and try to steer them and show them at the beginning, I'm not your enemy. I just want you to think through what you're doing. And what if you did it this way? That kind of stuff.
Yeah. And there's always a multiplicity of factors that, and we tend to be very myopic when we're addressing public policy of like, well, if we just adjust this one dial, then it's going to lead to this terrible outcome. Not realizing like, no, there's like a downstream cascading effect. And there's a multiplicity of factors that are driving the situation itself. And so we've got to consider all the different angles to this dynamic so that we actually come to the proper policy course. So very interesting. All right.
I'm sorry. I know you want one last just comment on
as this. Long as you're willing to stay on, Bob. I just really want to talk to you about AI.
Another element of all that is like with all the recent stuff about Lutnick and whatever, and they're talking about like, all the stakes the U.S. government's going to take in these companies. And I'm against that stuff too. And I was making jokes on social media about, MAGA's against Mamdani having New York City owned grocery stores, but they're fine with the federal government buying shares of Intel, that kind of stuff.
Right.
So I get all that. But on the other hand, in the grand scheme, I would rather a bunch of business titans who are very blockchain and hard money friendly types be advising the government rather than people who are outright socialists who hate private business. You know what I mean? If I had to pick. And so, yes, I will sit there and I will point out problems and absurdities, but in the grand scheme, I'm definitely glad that Trump won as opposed to Kamala Harris, for example. So,
and look, like a David Sachs in the administration is probably a huge advantage to crypto, for instance, because I know he's one of the major players behind it. So, here. Okay, let's talk about AI. Truly, we're going to talk about AI, Bob.
Okay.
Because I just really want your opinion on all of this. So, obviously, there's a lot of innovation happening, and AI is taking the economy by storm. And I'm seeing it make pretty large changes even to my own sort of old school industry of finance. And I think I see this potentially as a major disruptor. And one has to wonder, and of course we don't know the future, but one has to wonder, are we going through a type of industrial revolution of sorts? Is this the 90s again with the internet revolution? And is this going to be a major boost to worker productivity? I interviewed an economist. This by the time this is posted, this would be a couple episodes ago, with an economist, Matt Orton, who is basically the chief strategist for Raymond James Investment Management. So there's an asset management wing. And he described AI as like an exoskeleton in terms of worker productivity. And so I guess my question to you is, do you see this as providing significant advantages to worker productivity? And then furthermore, could this be another sort of significant wave of economic growth, maybe the way the steam engine was in the 1800s, or the automobile in the early 1900s, or the internet, right, at the late 1900s? Like, is this another big moment in history? And then what do you think this does overall to worker productivity?
So yes, I do. And because what you can do with these, just focusing narrowly on the large language models, the LLMs, things like ChatGPT and Claude and stuff like that, if people haven't had conversations with them, and I use that term quite consciously, like, I mean, I don't mean ask it a one-off question and then see what the answer is. And they go, oh yeah, whether it's good or bad or something, or give it some kind of brain teaser. And they say, oh, look, I got that wrong. What an idiot. This is stupid.
Yep.
I'm saying have a serious high-level conversation, and not where you're talking down to it and assume, no, talk to it as if you were talking to a cosmopolitan, well-read human who was very fluent in your tongue, because it's not just English. These things are, and just go back and forth with the thing. And I think you would be amazed at just the depth of the conversation you can have. And it might say some wrong things, but then you can point that out and then it'll correct itself. Just like if you're talking to a human, it's not that humans are infallible. They might say wrong things. And then what do? You just point it out. So just because I've done it like in my own, with the work I do at Infineo, there have been certain projects where I had to, for example, I was doing something with trying to show how if you had a pool of life insurance policies, when the cash flows came out of them based on mortality events, that like the band of predictability would be higher than if you just had one policy. I was trying to quantify that.
Interesting.
And to do it analytically, like, to do it precisely is really hard. If you have a bunch of policies, like the math, it gets tricky. And so instead, I just wanted to simulate. I just wanted to say, like, let me just do a computer simulation, these, like, to give the computer the probabilities of mortality for each policy. And then say, we got a pool of 100 policies. How do we know over time? And so it's like, oh, why don't we just do that and run the simulation 100,000 times and then just tell me the averages? So that's something, like, you can use code, but I'm not a programmer. And so I talked to it was Claude I happened to be using, explained what I was doing, and it wrote the code and did it and presented the nice result. And I even checked it. Like I did in Excel, like the case of a smaller number there where I could do a quote by hand just to make sure and it was matching my results to the second decimal place. So I was like, yep, I think it's doing the right thing here. And I'm just saying, and going back and forth. And so that's something where I could have gotten some programmer to do it, and it wouldn't have taken it, but it would have taken me the time it would have taken me just to explain what I wanted to that other programmer. Claude already did it, and then I tweaked the results. No, actually, I didn't want that. I wanted this. And it's just revising the Python code in real time as we're sitting there talking, and just keeps rerunning it. So I'm just saying that's just one example. And I've had plenty of projects like that where it's not so much that it's going to get rid of my job. It's not even that it's stuff that I used to do that now gets automated. It's like a combination of, things I would have done now take less time, but also I'm able to do a lot more. Like before, I would have just been able to do the report with the small number of cases that I could have done myself, like in Excel, and just checking it by hand. Whereas here, I could do the broader case. So what I think is happening and will continue to happen is more and more companies will have to sit down and they need to first realize what can these things do and what can't they do, and then figure out, can we redesign our workflow to incorporate that? Because there's a sense in which it's like for certain tasks, you have workers that they're like telecommuting workers. You know what I mean? So companies that might have workers who just deliver all their product over the internet to you, whether email or give you some kind of results or whatever, quantitative analysis. So just picture it like that. And then they have a decent IQ, And there are experts in certain key areas. That's the thing too. Like I was going back and forth with Claude on another issue about like Gödel's incompleteness theorems and weird. I mean, they have a lot of deep expertise in various fields too, and they can speak in English. That's the critical thing is you can ask it and it knows what you're trying, it quote gets the spirit of your question, which is amazing. So I'm saying as firms figure out how to do that, it's like having millions of workers like that just got added to the labor force that have those skills, and they will work for like $3 an hour when you run the math. And so you're saying that's not going to boost total productivity? That's
has to.
So that's kind of what I picture it. It's not that they're going to wipe out jobs. I think a better analogy is like using tractors in agriculture. You still need farmers. You just don't need as many people in agriculture. You can produce more and better food with fewer workers because they're using tractors. I think it's the same thing here, that you will need fewer people to be accountants, but you still will have humans who are accountants, but just now they'll have way more clients and be able to give much more sophisticated reports to them and keep track of stuff that before wouldn't have been worth it because now they're going to be aided by LLMs and whatnot.
Well, I think even particularly in my space where you still need a lot of administrative or secretarial work, and I'm starting to use an AI tool with note-taking, it's amazing. I mean, hours and hours and hours. And this is, I think, like a simple use case with AI. Obviously, you're talking about a lot more complex use cases for AI. But even in the simple stuff, for someone like me or a doctor or an attorney that does a lot of client consultations and has to maintain very meticulous notes, one is it's completely taking back tons of time for me. So hours and hours of time, hundreds of hours a year, conceivably. That's also stuff that I got so bogged down, I'd have staff sit in on meetings and take those notes. And that's honestly, frankly, a poor use of their time. Yep. They should be engaging in the business of advising or just doing more sophisticated administrative work for me. But then on top of it, my notes are a lot more in-depth and complete, which protects me from a regulatory standpoint. Mm-hmm. It helps me recall information when we're talking to clients in the future. And it's even creating CRM items for clients. And it's creating follow-up emails of like, hey, we spoke about this today. Here's a reminder. I promised that I was going to do this for you. And so it also reduces potential friction with a client when they're like, I thought you said you were going to do this. And it's like, well, here's the transcript. Here's the notes. This is exactly what we talked about. Oh, and did you see the follow-up email that I sent you? And so that type of, and I think, Bob, this is the simple side of AI, right? And I'm seeing dramatic changes. I've started to use it a little bit too for research in terms of comparing asset classes. And it's amazing. And you have to train it a little bit and work on it a bit. But it is remarkable to me how much information I can gather about price movements of asset classes and correlations between them that it would have taken a quant. I would have needed some kid down at MIT who was working on his PhD to run this stuff for me. And I was able to generate just some basic conceptual ideas to help me get my head around how do certain asset classes move with one another. And that information just comes so quickly. And I don't fully trust it yet. But as you start to work with it, and to your point, you can correct it. You can say, well, that S&P data, like, where are you getting that source? And then you can give it the proper source. And then it's like, oh, okay, now that data is more in line and it's starting to come together. I can see a clear, more accurate picture here. This is going to change every industry. I have a close friend who, by the way, is a huge fan of yours, who said that AI is not coming for your job, but people who use AI are coming for your job. How do you feel about that statement?
Oh, yeah, that's a good way of putting it. Right. One CPA armed with LLMs could put out 50 CPAs who aren't using it. So that's definitely true. Just a couple of follow-ups to what you're saying. You're right. The thing is, people say, oh, so you're saying, Murphy, like, that as GPT-9 comes out eventually, and I'm saying, no, if they just came to a screeching halt, and if those LLMs could do nothing more than what they can do right now, I am saying eventually, as businesses figured out how to incorporate those and change their workflows, you know what I mean? It's like when they came with an assembly line, like you had to change the way you were making the cars.
Well, it doesn't happen overnight, right? Like that took years to implement.
Right. So I'm saying that, this stuff here, like even if they just came to a screeching halt and they could just stay at their current level of sophistication, that yes, that would in the long run have a huge impact on average human productivity. But of course, they keep pushing the boundaries on those things. And then, the two issues that I see are the one that you said with the it's called hallucination, that, yeah, they will just say things with confidence. And that is the one. And I even one time like had a conversation, I think it was GPT-4 about that, and said, because I caught him, I was talking to him about Dr. Strangelove or something, and it got the character wrong. And it was confidently telling me that, off the top of my head, I can't remember which it was, but they were telling me that one, like it was the Texan guy or something saying something when it meant it was the other one. And I pointed that out to it. And I said, I think you're confused, that the dialogue you're tripping was actually this character, right? And it went, oh, yes, I'm sorry. And I said, if I hadn't known that, we wouldn't have discovered that. And so, is there any way that you could have told me the degree of confidence? And it said something like, no, the way I work, I don't really have degrees of confidence the way humans do. It's just that's my algorithms told me that was the right string of letters to put out, and that's what I did.
Too funny.
So it was kind of interesting that there was no way. It said, if you want, for all my future answers, I can give a disclaimer and say you should go. And I said, yeah, but if you say that for everything, then that doesn't do anything. You know what I mean? Like it.
Well, and I ran into that and I'm not using AI to generate portfolios at all yet. And I don't even know if that's approved for use anyway, but just wanting to test like concepts. And it was totally hallucinating about S&P data. I was like, where's this even coming from? And so you kind of have to your point, you have to coach it. It's just like, I don't know what it was pulling. I don't know where it came from or how it came up with it, but it came up with something. Yeah. And it was wildly inaccurate.
And the other, I don't know if you
And I don't even know if that's considered hallucination, but it just created something.
Yeah. I mean, that's the term people use, is that it will just confidently, like it's stuff too, like, hey, give me a list of 10 famous authors that have written on this subject or something. I'm doing a term paper, kids cheating and using. And sometimes they'll give it and the kids will put it in their thing. And that's one way that the teachers catch them cheating. Right. Is they'll have citations to books that just don't exist. Like the AI just made it.
Yeah, so, literally made up books. I've seen that. Yeah.
And so you're like, I think people have this idea that, the computer is going and doing stuff I would have done. It just does it faster. It's like, no, the way they're generating those results. And so on the one hand, it's fascinating that it's doing it, but on the other hand, it's scary when you realize that, no, there's in a sense nothing under the hood. It's not like there's this little guy behind the keyboard that's thinking about your question. It's just that, no, this is what the algorithm says is the best combination of letters to put in response to what you typed in. And it doesn't mean anything to the computer in some metaphysical sense. The other thing too, that I noticed that is a problem that they will have to figure out a fix for, and I don't know if you've encountered this, is like, I'll say a lot of it is something that I can do piecemeal, but I'll have a lot of data that needs crunching. So I'll have a conversation for a few minutes to get Claude or whatever to know this is what I'm working on. This is what I want. Okay. Yeah. And then here's an Excel file I'll upload to you that's got 1,000 entries. Do it. And it'll do like the first 50. And they go, there you go. And I'll say, wait a minute, but how can that be? And it says, yeah, I just did the first 50 just to show you what it looks like. And I'll say, yeah, but I wanted you to do it. And like, I'll have to like plead with
it's like having an actual employee.
Right.
No, I told you we're going to organize all 100 files, not the first 5.
And it almost like it doesn't volunteer that here I did the first 50. It acts as if it did what you asked. And it's only by looking at this, wait a minute, you only did 50 of them. And it's like, well, yeah.
So you told me to do.
I just showed you how to do it. You can do the rest. And so so I asked here at Infineo, with like Christian Hubbs has got a PhD in machine learning, Carnegie Mellon, like he's our AI guy. And I asked him about that, and he said he thinks where that comes from is because remember, they just scour the internet and just look at all sorts of stuff that's on the internet. That's how they train them to get their like worldview and to know how things work. And he said, yeah, that's because most of the things you'll see online to explain some concept, whether it's from a textbook or a tutorial, video, whatever, is someone will like show the concept to the viewer or the reader and then just follow the pattern. It's not that in a math textbook, it will go through all 1,000. It will just show you the principle. So that's what they think. Oh, when a human asks you to do something, that's what a good answer looks like, is you show them this is how you would do it. Now you go do the rest. I just showed you how. And so, you know what I'm saying? Like, it doesn't think it's being lazy. It just thinks that's what I've been trained to think a good answer looks like.
That's exactly right. You've touched on it slightly, but there's a lot of concern that a lot of people are going to get displaced. And maybe there's some level of Schumpeterian creative destruction that occurs. But do you think this is going to lead to significant job losses and replacement? Or do you think they will find newer, better, more sophisticated jobs? What do you think the implications are?
All right. So in a laissez-faire free market world, there would be a lot of displacement, but yeah, ultimately I think everybody, it's boosting human productivity. Like everyone can do so much more with this stuff. It would be like looking at the world of the Jetsons and saying, oh no, like George isn't allowed to drive anymore. Now he has to fly around in his car and look at it. And it's like, no, that's what it would look like when the robots and the machines are doing most things. It's that, yeah, you're sitting there pushing some buttons and stuff is happening. And in a sense, it's like, look at all the work and jobs that the machines took from the Jetsons family. But that's also equivalent to having a really high standard of living, that you have to, quote, work 1 hour a day and live it like kings compared to us today, right? So that's what progress looks like in the grand scheme. So I would say that. Having said all that, though, I do think that you're seeing a bunch of different forces coming together. Like there's this big push for UBI, universal basic income, and things like that. And so I am concerned that there's the various powerful players involved on the world stage might be, they're doing things that they're trying to get us to a place where it is hard because of government regulations and other factors for the public to go get conventional jobs. It's like, oh, once you get displaced because AI took your job, here, just get on the government dole and we'll pay you. And so just to transition, so to get people just to think, like, oh yeah, I just put in my virtual reality headset. I live in an 8x8 cubicle in some high-rise apartment. Nobody owns homes anymore. And I just get plugged into that and I just live off of that stuff.
It's a self-fulfilling prophecy too. It's like, well, they don't want this to happen to society, but then they're going to create a set of incentives where they actually force people, or highly incentivize, I shouldn't say force, but they incentivize people to then go on the universal basic income, and then they don't go and get a job. And it's like the thing that maybe they're worried about, they're literally behind the scenes actually pushing and creating. I guess that's the unintended consequence of it. So you do have some concerns, obviously. One of my bigger concerns is less economic. Like not to get overly philosophical, I'm actually really excited. I think this could lead to a significant wave of economic growth, which I think our country and the global economy needs. And I think it could not fully solve, but partially solve some debt crises issues. I think it give us a boost in economic output. There's a lot to be excited about when I put on my economist hat. When I put on my father hat, or I look at friends and kids that are being raised in this, like I had to learn how to write. I had to learn how to write a persuasive article. I had to learn how to use good grammar, use punctuations. My concern is, are certain basic human skills going to get lost in the shuffle? And will there be some trade-offs, some societal costs with the machines doing so much more work that frankly we used to be able to do ourselves, and maybe we should have some knowledge for?
So there's certainly going to be trade-offs. I've just noticed this, and it's partly, I guess, just as you become a crotchety old man, this is how you do. But I'm not doing it to trip the kids up. But when I go through like a drive-through or something, and I'm getting a coffee at Starbucks, and then it is whatever it is, and then I pay, and and I have some shit, like, and I want to,
yeah,
I give more, but I don't want to have them give me 62 cents back, and so I give them more. It's just amazing how much they don't get what I'm doing. And one time it was like the bill was $17 or something, and I gave them 20 and plus some stuff to get a 5 back. And the kid looked at it, and he gave me the food and then gave me my 20 back or something. Like he just didn't. And I went, no, you need to take my payment, And so anyway,
he was hallucinating like AI hallucinates.
Yeah. And I know, because he typed it in, you know what I mean? Like he had the wherewithal to realize, well, I'm just let the computer do it. But when he looked at the thing, he looked at the wrong number. He must have looked like amount tendered and said 20. So he gave me instead of giving me the change.
But I declined it just the other day. It was actually 2 days ago. And he was saying that he was at Market Basket, which you probably have Market Basket down in Mass. He was at Market Basket, which is a grocery store up in New England. And he did the same thing. He gave the cashier money and he's like, hey, here's money, here's some change. Because he wanted even dollars back. So you give the exact change that's on it. And he said, do you know what I'm doing right now? And the kid was like, I'm really confused. And then he's like, you should talk to your manager about how to do change. I think he was this is kind of alarming. Like there's some basic tasks that like that's just second nature. We all knew how to manage cash as kids, but they don't at all anymore.
Yeah.
And is that a problem is the question, Bob.
Right. So definitely that's happening. But then, when I periodically posted stuff on social media, some people would come back and make fun of me and say, nobody's going to be using cash in 5 years. Like it's just you and your boomer. Like they think I'm a boomer, even though I look like one. I play one on TV, but I'm actually not.
You're Gen X, right?
Because another one I complained about too is I was in a Walmart one time and this kid was walking by, an employee, he's got the uniform on. He's walking by me and I said, hey, I forget what I was looking for. Is such and such, would that be in aisle 17? And he said, yeah, probably. And he just kept walking. And he wasn't rude. It was just, I asked him, and then he did catch himself and then came back and said, do you want me to go check? But I mean, it was just, that was his natural inclination. And so I joked about that. And then people were saying, yeah, because we just use our phones. You can go just look on your phone right now and it'll tell you where in the store. Why would you ask someone? That's stupid.
Why don't you just order it while you're standing in the aisle and then just pick it up front, right, not even use a cashier?
Yeah, drone will bring it to your house. Yeah. What are you doing, old man?
So I know there's AI Bob at Infineo, but when we talk like this, you will officially be Boomer Bob. So this is Boomer Bob now.
Yeah. So all that is to say that I do get that some of these things, like Mises had a good, I'm not going to be able to do it justice, but he was talking about that some people were like critics of capitalism. And this is Mises writing like in the 40s. And the critics of capitalism were lamenting like the Industrial Revolution and how there was a virtue, like the people, like the farmland, when you were on the homestead, and there was a virtue in that and the civic responsibility. And now everyone's just a cog in the machine going into the factories. And Mises said, okay, but with the rise of agriculture, that was a change too. And he said before that, people were hunter-gatherers, and you could have talked about, and he said there were poets and whatnot lamenting, oh, now we don't have the thrill of the hunt and going again. Now we're just sitting around waiting for stuff to come up out of the ground because we water it. Like, what kind of lazy, sedentary people do that? Agriculture is boring, right? And not manly. And his point was just, stuff changed. So I think it's a similar kind of thing here where, if we are moving to digital-based finance, whether it's CBDCs or private voluntary blockchain-based stuff like we've been talking about earlier, ultimately, probably you don't need kids to know how to make change in the grand scheme of things.
My kids are heading to the coast. They're going to Portsmouth with my wife today. And two of my daughters are like, Dad, you owe me $22. Well, guess what millennial dad, because I'm 41. So millennial dad did not give, I guess my kids are Gen Alpha, or maybe it's Gen Beta. I don't know.
I stopped keeping track.
It's confusing. I'm old enough now that I don't know. So two of my daughters said, well, Dad, you owe me $22. And I didn't reach into my pocket and hand him $22. But they're like, get on the Greenlight app. So there's this app called Greenlight, and you give your kids debit cards, and it's like, they're just used to transferring money. So it's just literally digitally transferring money to their debit cards, and they can use it whenever they want. And so they don't know the world of cash. They do know how to use cash, but they don't know the world of cash the way you and I did. Okay, final question for you, Bob. And I really appreciate your time today. As I think about, and actually let me make one point. When it comes to AI, my take on job loss or creative destruction is, whenever we've had major innovations or technological changes like the Industrial Revolution, it has never led to less jobs. It's always led to more. And so in this argument, I feel like it's always made, we're going to lose a bunch of jobs. And I actually don't think that's going to happen. I think it's going to create more jobs, better jobs, and I think they're going to be better paying, and living standards are going to go up. There may be some social costs, but we'll have to deal with that as a society.
Yeah, I agree with all that.
Yeah, good. Okay, so my final question for you, Bob, more around the free market group is, I hear so much negativity about, well, the government's doing this and they're creating national debt and they're waging wars that are expensive and there's a lot of corruption and we have a devalued dollar and there's almost like an obsessiveness around the negativity with the economy. And then I feel like, and I'm going to pick on libertarians in particular because I see this frequently, there's almost like an ignoring or a desire to not even see the other side of the equation. And so, yes, I see problems from an economic standpoint in terms of government and interventionism, but I also see amazing innovations and breakthroughs like the discussion that we just had. And I feel like there's this breakdown, particularly with academics, not to pick on people, but with academics in general, where they only see the bad and they don't see like, hey, this is a dynamic situation where sure, there's problems with a large government and there's problems with the state, but there's also significant economic advances. And it's like it doesn't exist in some ways. Do you see that as sometimes being a bit of a persistent problem? And could we maybe do a better job as people who think economically of sort of balancing out the pros and cons from an economic standpoint?
Yes, it is a problem. And I know what you mean because I get sucked into it myself sometimes. But yeah, there's particularly like just on my own personal experience and the people that I interact with, the circles I move in, that, yeah, if you're part of a group that largely is very critical of the actions of the government and I think for quite legitimate reasons or whatever, that does like you feel like, oh, you have to develop a vigilance. And anytime they say something, they're lying about why they're doing it. You got to be careful. And they're just trying to steal your money or take away your liberties and da-da-da-da. And I think that's largely accurate.
It may be true, right. But is there positive stuff on the other side?
That does breed a certain type of cynicism where you're a cranky old person. Like, you almost get the sense that, and people making dire warnings about things where they're almost rooting for the bad thing to happen so they can be right. And then it's
that's exactly what's going on.
And if disaster doesn't happen, then it's almost like, oh, well, still, you
wait 5 more years.
So, and you see it too, like in foreign policy as well, where if people are very much against something, the U.S. government doing something or whatever, that you could, I think, correctly give like, hey, there's all these bad things that could happen. And then if it doesn't happen, the concern is, oh, does that discredit me now? And so anyway, there's all that stuff going in the mix there. And so I'm very cognizant of that. Also, too, there was a great example of this that Peter Thiel was interviewed by Ross Douthat recently. The clip that went viral, I don't know, did you see it, Drew? Where he was asking about
I'll look it up after.
Yeah, so it's a funny thing where Thiel goes off on stuff about the Book of Revelation or whatever. He's talking about the Antichrist, and Ross Douthat says, well, don't you worry that you're building the tools that the Antichrist will use? And Thiel's like, huh. So anyway, that was the clip that went viral for obvious reasons because it's such a provocative, juicy clip. But he said something earlier that was a really, I thought, a great point is, Douthat's asking, I might be missaying his name wrong. I don't know how to say that guy's last name. But he's asking him all these questions, and he said, Peter Thiel said something like, yeah, Elon Musk, I forget the exact quote, but still believes that by the year, I'm making the spirit of this is right, that by the year 2040, we're going to have 10 million humanoid robots, at least. Or, they might have even been bigger numbers. I can't remember. I think actually it was. I think he said 100 million. By the, maybe it was 2050. I don't remember. But he said in the not too distant future, we're going to have these millions and millions of these humanoid robots. And then Thiel's point was, so then why is Elon running around worried about the federal debt? That if that part of his worldview is true, then that should have implications. Like, why does he care about, the big, beautiful bill or whatever? That's a rounding error if we're going to have 100 million new workers coming online with all these capabilities and stuff.
This is exactly my point.
So I thought that was a great thing where I don't think that Elon is lying. I think it's just he wasn't, those two parts of his worldview, he wasn't having interact with each other. And so I definitely think, and I've been in that issue too, where I don't think I contradicted myself, but there was a period where I was very concerned about the U.S. economy crashing because the inverted yield curve and whatnot. And when I really was convinced of the power of AI, and I started making back of the envelope calculations about the boost to U.S. productivity. And then at some point I was asking myself, do I need to pick? And so I still think there is the best of both worlds or the worst of both worlds, where I do think short term, we are still in store for a crash because of what the Federal Reserve has done. But I do think longer term that, productivity is going to rise. So anyway, I'm just saying that, definitely I have seen those competing trends. And that, with libertarians in particular, last thing I'll say on what you said there, Drew, me growing up in the libertarian tradition, typically what we would do is prove the naysayers wrong. They're worried about climate change. They're worried about acid rain. They're worried about overpopulation. They're worried about one big giant monopolist taking over. And a lot of the stuff is just poo-pooing that. Just say, no, look at living standards have risen over time. Look at women now have way more freedom than they did, in the old days and blah, blah, blah. Just showing all the benefits of the market economy. And then that kind of flipped at some point.
I know.
And
what is that?
But I think it's not just for no good reason. Now it is true that there's a lot of big corporations that are in bed with the government and a lot, you know what I mean? So
agreed.
And the U.S. now is certainly much more of a crony banana state than it was in 1985.
Sure. So
anyway, I think there are reasons, but I am cognizant of that. And that now when I see libertarians who are still more writing like the ones in, I recently had I don't know if debate's the right word, but an exchange with Nick Gillespie, because he had said something like, this is the best time in human history for human freedom. And I said, that's weird because my cousin I do Bible studies with, we're wondering, is the Book of Revelation right now? It's so the disconnect there.
Yeah.
And so he and I had a thing just trying to flesh all that out. And my last thing I'll say on that is, Drew, I was saying, to me, it's like looking at the world of the movie The Matrix, where they had a bunch of cool technology, but on the other hand, it wasn't a pretty vision. And so you can blend both. You can think that there's rising technology and innovation and human productivity is going to go up, but also if there are large malevolent institutional forces at work, it's not obvious, how that plays out.
Yeah, the circle of utopian to dystopian might kind of come around to the same place at a certain point. Bob, thank you so much for your time. I know I kept you on a long time, but you just have so much thoughtful information. So appreciate you coming on today.
Thanks for having me, Drew. Always a pleasure.